So like Ryan was saying, looking at the IPO market with CoreWeave, but before we really get into CoreWeave, I just want to show how weak the IPO market has been the last few years, well, 4 years, going on 4 years now. So we had 2021, really the year of the SPAC is what I'd call it. We had tons and tons of SPACs going public. But since then, IPOs have just floundered both by the dollar value as well as the count of IPOs. And now we've been slowly seeing it gain a bit of traction, and CoreWeave is really one of the headline IPOs, or expected IPOs, I should say, for 2025. So is it going to be a sign of things are turning around for the IPO market, or is it just going to be downtrodden markets from here on out? So moving to CoreWeave. CoreWeave symbol CRWV on the NASDAQ is an AI hyperscaler. The company uses proprietary software and cloud services to deliver complex AI infrastructure at scale. Simply put, really, they build AI-focused data centers. They have over 250,000 GPUs across 32 data centers with 1.3 gigawatts of contracted power. The company is an AI pure play, trying to capitalize really on that AI boom, which requires immense computing power and therefore immense electrical power as well. They currently have relationships with big names in the space with Microsoft, Meta, as well as recently OpenAI. So moving to the price, the IPO is really disappointing for investors in the company as well. That could be a bit of an indicator for the broader IPO market, just to show my cards a bit there. Initially, the company was targeting a price range of $47 to $55. However, the stock ended up listing at $40 a share and closed $40 a share the first day of trading. However, Monday morning, as we record this, the stock has fallen roughly 8% and is currently trading at $37 a share, resulting in market cap of $17.5 billion. That's about 28% lower than that midpoint range that the IPO was expecting last week. So not great for the owners of the company before it went public. I will say, however, this is quite normal for post IPOs to be quite volatile. And with the market being already so volatile as it is, especially in tech names, an 8% drop isn't the most surprising regardless of the company's underlying fundamentals at this time. And by the time you're watching this, I would not be surprised if the price was quite a bit different than what it is today. So moving to the financials for 2024, the company had revenue of $1.9 billion, significantly higher than the prior year's $229 million, that is, clearly putting it in the growth spectrum of companies. They had a gross margin of $1.4 billion, a 74% gross margin, the main costs of revenues being electricity, rent, and just related later to operating their data centers. The big cost, however, for the company is technology and infrastructure of $961 million. This is electrical and computing components, depreciation expense, which are the main capital expenditures for the companies, mainly being GPUs. The company actually invested $8.7 billion, that's the cash value, roughly half the current market cap, into PPE, so property, plant, and equipment, and internal software last year. So a massive dollar amount put into GPUs primarily. And that results in a net loss of $863 million for the year on a GAAP basis. But looking at adjusted EBITDA, it does appear quite a bit better than net income at $1.2 billion, as you remove significant depreciation expense of $863 million, materially the same as the net loss, so you're at break even at that point, as well as fair value adjustments for derivatives, warrants, convertible notes of $756 million, as well as an interest expense of $361 million, being those big line items for EBITDA. Moving to the balance sheet, the pro forma net debt position, so adjusting for the funds raised with the IPO, came in at $5.2 billion. The company primarily used those IPO funds actually to pay down term loan debt of $1 billion, as well as providing a $500 million collateral for a delayed drawn down term loan facility. That is that jump in restricted cash of $500 million you're seeing on the screen. So effectively, the IPO capital was just used to lower the debt load. And with their interest rates being as high as they are, they had an effective interest rate of 14.1 and 10.5 for the first and second facility, respectively. Is not exactly surprising. They're looking to lower their debt load, as they are even further expecting to have significant capex going forward. Further, the company as well, I will highlight, they finance this equipment, which ranges from 9 to 11%. So overall, just not exactly cheap debt. It's not surprising they want to lower that load a bit. Using the pro forma net debt and adjusted EBITDA for 2024, the company had a net debt to EBITDA of 4.2 times. quite high, especially given that the IPO actually reduced that debt load. So moving to valuations, using the 2024 figures and pro forma net debt, the company is trading at an EV/EBITDA of 18.6 times, which does imply a continuance of significant growth expected by the market, and I would as well, at least for the top line. As well, I will note here the weakness of actually using EBITDA for a company like this, as they are so capital intensive, and EBITDA removes depreciation. And further, the depreciation value used likely, in my opinion, does not represent the true change in asset value, which I'll get into in a minute why that's the case. And further, if you just look at the top line, the price to sales is 9.1 times, which is quite high as well, given the capital intensive nature of the business. Overall, even though it is trading well below the initially desired amount of the IPO, it is still a pricey business at the end of the day. So onto those couple of risks I want to highlight. The first risk, the company's GPU base is mostly NVIDIA Hopper generation GPUs, mostly H100, H200s. So that is NVIDIA's current leading API architecture. But of course, being technology the way it is, it does change, and it can change very fast, especially for leading edge technology products like AI and GPUs in general. NVIDIA's next generation Blackwell is released this year, with initial NVIDIA benchmarks result putting it at 2.2 times and 2 times Llama 2 and GPT-3 training compared to H100 GPUs. The point of this really is, me going through it, is that if CoreWeave wants to keep up and being on that leading edge of AI infrastructure, they need to continue to invest capital, and lots of it. In this refresh, you'll likely have, in another few years, another new architecture that will likely have a refresh next year, and it kind of follows that cycle. New architecture, refresh, tick-tock. In that sense, they do change every once in a while, but that's a pretty normal cadence for any semiconductor. So the first Hopper GPU, those H100s, were released in March 2023. So 3 years ago, they had a refresh. About 2 years ago, that H200. The company depreciates its technology equipment over 6 years, meaning any Hopper GPU that they're purchasing now at this time today won't be fully depreciated until the architecture is 9 years old, which is a very long time for leading edge technology. And the performance and efficiency of its architecture by then will likely be poor in comparison to technology that comes. Remember, a big input for the company is electricity. The less efficient a GPU is in respect to the current generation, the less value it will have, even the resale value or new value, whatever you want to call it. So in my opinion, this likely understates the actual depreciation value to the true fair value of the underlying GPU, the capital, or the capital infrastructure, meaning capital expenditure also likely needs to be higher than the accounting depreciation financials would imply on the surface. The second risk I will highlight, on the other side of the equation, we really have supply of that AI infrastructure there, and now we're looking at AI training demand. That needs to continue to have high growth. The company references expected growth from Bloomberg of 38% from 2023 to 2028. Generally, AI growth I'm much less concerned with than the demand, the structure of the actual businesses here. But to keep that high valuation like CoreWeave currently has, you need underlying growth. You need both top line growth to hit then the bottom line after that. But to get that top line growth in the first place, you need an industry demand that supports it. And if the whole industry stops running at this really breakneck speed now for the size it's at, especially when the company is largely funded by debt, that can run into problems. The AI boom is, of course, underpinning really the bull thesis for any of the bulls of the company. So AI, to meet that criteria, just needs to continue the rapid growth. Therefore, training needs to be done, and therefore infrastructure is needing, which is where CoreWeave comes in. You need that whole chain of events to happen for CoreWeave really to succeed, which starts with AI training being in demand. So concluding, CoreWeave really has had a rough start with its IPO hitting the market under initial price expectations, and at least relatively early trading shows the stock moving even a bit lower. The business model is risky. It depends on the rapid growth of AI demand, but that can also be hindered by the significant capital expenditure which is needed to fund the company's core operations. And if the IPO is any indicator of having the capacity to even raise those funds, that could be a bit concerning considering that it came in well under what it was expected to come at. Or perhaps it's just bad timing in a beaten down tech market for that side of it. But overall, I don't find CoreWeave appealing at this time since the debt load is significant. You have a high valuation. You're reliant on a depreciating asset, which is going to require that continuous capital expenditure and for the price. Even though they do have high growth, it just seems too high at this time for the risk and reward combination. We will continue to monitor the stock if it does come appealing, but for now we'll sit on the sidelines. And for disclosure, we have no position in this stock. And I will even say we don't have a short position because people always say that when we're even remotely negative.
Yeah, good segment here. I think just generally too, like it's interesting if like there was a lot of articles I remember reading just as Trump was taking office, and like I've got a Forbes article in front of me right now. Will Trump 2.0 reignite the sluggish IPO market? And like a lot of analysts in this article were saying, just generally deregulation was building enthusiasm like around crypto, energy, and AI. And they say in here, this is a quote: some sectors of the market will clearly benefit from what we believe will be reduced regulatory requirements, such as the crypto and AI subsectors for starters. If reduced regulatory scrutiny results in more rapid, if possibly temporary, growth in some sectors, the projected valuations will likely rise, and those improvements will translate into more enthusiastic or a busy IPO calendar. I mean, we'll see how this translates, but I think just generally the uncertainty that Trump has created has made more of a dark cloud above the IPO market in general. At least that's my take. Maybe you guys.
The market just simply doesn't like uncertainty.
Whatever causes the uncertainty. Uncertainty is something that leads to risk off and sell-offs, and you need, the markets want to make their perfect models, and you do that with a more certain environment, right? So if we don't have that, whatever is causing it, you don't have capital being deployed at the rates that you would see it in a certain environment, or at least a somewhat stable environment. So until you see some stability, the IPO market probably freezes up, and that's what you're seeing right now, I would say.
Yeah, I think that it's good too that like it's another great segue, but Brett was just talking about growth, and if you see growth tapering, it can lead to compressed valuation multiples. I think that.